Good morning or good afternoon, depending on what side of the country you're joining us on today. Super excited to have you with us today. Um, it's nothing like having an economic update on a Fed week. So really, really excited. So thank you for joining us for our mid-year economic update on June 15th. Charlie McQueen, president of McQueen Financial Advisors. Really excited to be here with you today. I'm also excited that of our three separate teams we have here, we have our investment advisory team, and one of our advisors in the investment advisory team, Alicia Bradley, is joining me today. Also have our asset liability management team here and our valuations and transaction advisory team here. Surrounded by a whole bunch of wonderful people, and I want to thank them all for their input that they've given to this economic presentation. With that, I want to introduce my co-presenter, Alicia Bradley. Alicia, thank you for joining me today.
Thank you for having me.
Alicia is one of our senior advisors who works with a number of institutions across many parts of the country and advises them on their interest rate risk outlook and their bond portfolio management, and is one of our lead bond portfolio managers and trainers. So thank you, Alicia, for joining me. Really appreciate your expertise today.
Absolutely. Excited to be here.
All right. So today, as we kick stuff off, a little administration stuff. If this video is being recorded, if you'd like a copy of it, please reach out to your advisor, or you can go to our website and grab a copy of it there, or our YouTube channel. Additionally, if you have questions somewhere on your screen, top or bottom, there'll be a Q&A button. Please feel free to click on the Q&A button along the way, and we will answer the questions and answers either at that point or later if it makes sense. So please feel free to ask really, really tough questions, and I'll hand those all off to Alicia. Well, with that, we have to go back to the 80s. I mean, the 80s were a really exciting time, weren't they, Alicia?
Yes, lots of Aquanet, lots of capri stretch pants, big wedge shoes.
Yeah, see, the 80s were cool. All right, so why are we starting with the 80s besides to make fun of people's ages and have all sorts of fun here? We'll let that go, as I'll get made fun of the most since I have the gray hair, the call. The 80s is really an interesting time. This is the birth of interest rate risk management and asset liability management. Also, a couple other things happened here. We might have had, a little bit of higher gas prices possibly, Alicia?
Maybe just a little, just a little. It's all relative, though.
Yeah, back then it was only gas prices that were skyrocketing, which is interesting.
Yes.
Compared to today, we have diesel prices, gas prices, electric prices, and then also natural gas prices. The Federal Open Market Committee was they stopped inflation, and they did it with a hammer or chisel. Which do you think it was?
I feel like it was more of a hammer than the chisel.
Yeah. So we had massive inflation, and the Fed raised rates on the Fed funds rate from 5 to 22. And if we look back, the reason why they went up is, well, inflation was up. We started in the sevens, 6, 7 coming into this, and then we bumped up once, then we came back down, we bumped up again, and that's where we hit about 16% inflation. Pretty big number.
Huge number, especially compared to where we're at today.
Yeah, it's interesting. Going from 7 to 16, 17 is a doubling. If you look at where we've been today for quite some time here, really low numbers here. But we were in that 2.5.
Roughly.
Yeah, for a long time, 2.5, 3% for a long time, and then the rocket ship took off here. But it
Great
does have
analogy.
a little hook there, which is pretty cool. So the Fed just had to break inflation back here. That's a deadly level. As what they look at this today, based off of the relativity of where we've been for a really, really long time, since the 90s. So the primary hammer, we'll say, that they have is called the Fed funds rate. I know we've all heard of this on this call. It's something that's around quite a bit. But here we go. The Fed raised from 5% up to, my eyes are getting bad because I'm so old, because I remember the 80s. What is that there? Is that 20 something?
22, 21 and a half, somewhere in there. Significantly higher than we were at today, or are at today.
Yeah, one of the things the Fed is talking quite a bit about, or at least the talking heads on TV are talking about, not the Fed. You can see here they went up to 20%, then they came back down to 10. I mean, talk about volatility here. Only cutting it down by 50%, but then to go back up to 22.
Yeah.
Is that a bit of a worry with the pause right now that the Fed might be putting themselves in this trap right here?
I think if you look at the rate at which they increased in both of those instances and compare it to the rate at which we've increased now, it's definitely been a steep movement. 500 basis points over the last year is certainly not what any of us expected, but the moves have been significantly more measured. It hasn't been 600 basis points at one time. It's been 500 basis points over a point of time. So we've seen a little bit less volatility in the number of increases that we've seen over the last year, given or compared to the 1980s.
Yeah, you look at the volatility, the big moves, it was really quite crazy. And then even the volatility up until 2000. I mean, at that point's when the Fed got a bit more of a, I say, a measured pace and going to the 25 basis point moves a lot more.
Yeah.
And here we go, and we end up going into the financial crisis here. We had the dot-com time frame, the year 2000, but then the financial crisis, and then this time of unprecedented time of zero, which really reset all financial assets to really, really low levels, thinking that we've been at zero since, before 2010, 2009.
Yeah.
So that's a long time going all the way to 2022. And then once again, the rocket ship.
Taken off.
Yeah, we did send a nice letter to the Fed thanking them for the last 25 basis points because we ended up having a 500 basis point increase, which means that we could test our plus 500 in our ALM report. So I was really excited about that. It was very thoughtful of them.
Very thoughtful. I'm sure the ALM team appreciated it as well.
They did. I mean, that's why. Well, obviously the issue is inflation. And with inflation, the Fed has to stop inflation because they don't want the outlook. They don't want the effect of inflation. So if we look at this, inflation we measure in a couple different ways. One we can call is the consumer price index, aka the egg price index. We have the consumer price index ex food and energy, which is running at 5.3, and then the PCE, the personal consumption expenditure core index. Now, Alicia, I know you appreciate one of these, but which one does the Federal Reserve like the most?
They like that red dash line, personal consumption expenditure core index. It's a mouthful of words there. Currently at 4.7, they want to see that number come down to 2%. There's been a little bit of talk, and is 2% the right number? Does the Fed need to relook at what that inflation target should be, given where we've been at and the very different economy that we're facing? I don't know the answer to that at this point in time, but that is their preferred measure of inflation, that red dash line. And then we as consumers tend to focus on those blue and black lines a little more, as Charlie called, what did you call them? The egg inflation indexes?
Egg inflation index. That's the
Egg
black dotted
inflation
line
index.
because egg prices went way up.
They did. They went way up. Those were not inflation related, though. Those were avian flu related. And they've since come back down, but it's still could be considered inflation. It was a supply and demand issue.
Yeah, there's a lot of supply and demand issues really went through, and that's the consumer price index, all goods, and why we're up to 9%, and it's all the way back down to 4. Now, we also saw the consumer price index ex food and energy just came out yesterday, or 2 days ago, down
Tuesday,
to 5.3. Yeah, Tuesday, thank you. It's 5.3, so it's coming down. But the red line here, the PCE, I'll shorten it for you. The PCE is staying at 470, and that really the trick there is we haven't had the meeting yet. When is the next release on that? Is that next week or 2 weeks out?
I don't recall. I believe it's 2 weeks out yet.
Yeah. It had to stump you somewhere, so we got that
Yep,
off the
that's
table.
where you got me.
Perfect. But that's the one the Fed's going to pay a lot of attention into. And as we think about the outcome of this webinar today and what you should think about interest rates, it's really going to be based off of this number. If the PCE number, personal consumption expenditure number, comes down, the Fed is going to be less likely to raise rates. They're potentially threatened yesterday to raise rates 2 more times. That's what they're really going to be keeping an eye on. Do you agree with that statement?
I do. I think that we'll watch inflation numbers. Inflation is only one part of their mandate. They have a dual mandate. Inflation is one piece, unemployment is the other. And I know we'll cover that in here in a little bit.
Yep. But I do think this first step, you so eloquently said, supply and demand issues.
Absolutely.
Go back to avian flu with the egg conversation we were having here. But supply and demand made a lot of inflation things happen with the inability to truck goods, inability for space on ships, inability to empty things at ports, inability to manufacture things, China being shut down. A lot of different things came into play. And so that's one of the big causes of inflation is the result of supply and demand, not enough products and too many buyers. Yep. Another cause and effect here is this neat thing called M2, which is money supply.
Yes.
And we've talked about helicopter parenting all the time. It's a great conversation here in the office. We can talk about helicopter governing, where the government flies by and dumps money out of a helicopter on us. And as money supply grew and continues to grow, exponentially grows, the turbos came in here and the money fell out of the helicopter. And we look at all the money from all the COVID activities going to individuals, businesses, and municipalities. And that gave people more money, and also the same point of a lack of supply, which really doubled up the inflation game.
So it looks like this graph is coming down. Is it accurate to say that the money supply is decreasing, or are there other reasons for that slight trickle downwards at the very end of that graph there?
Yeah, so when we look at money supply, it usually doesn't get smaller unless money is pulled out of the system, which means the government has to remove money and keep it for themselves. And what we've seen happen here is a little bit of this is inflation-based data, but some of it is as the government starts to issue a lot more debt. We're talking about them issuing $1 trillion worth of debt, and that they give it to themselves, that will cause it to come down. It's difficult to get money supply to shrink, but they can stop it from growing. And
Okay.
that's one of the things with quantitative tightening we're doing. Remember, we're not in the steamship QE2 anymore, out with Craig's Pirates, as we read about yesterday. We're here more with the tightening activity, which is taking the gunpowder away from the aforesaid pirates. So definitely tough. This is going to be something that has been a big cause of inflation, was all the money out there. And as this money is gone, no new money is there, that's causing people's spending habits to have to change dramatically. And speaking of spending habits, it's really hard to spend money when you're locked at home with a mask hanging off your chin and hanging out in the backyard. Stores are closed, but when the world changes, all this money's dropped on everyone, and then we can actually go spend it. You look at planes, they're full. You look at travel, it's crazy. We had someone here in the state of Michigan coin a term, revenge tourism. But what's happening today is a lot of people are not saving much money, is probably the right way of putting it.
No, I think that's a fair statement, but I think that leads back to, in part, that supply and demand issue. When the economy reopened, we all had the ability to go out and spend money on all sorts of things. And that's where we really started to see some of those shortages, whether it be electronics, talked about vehicles, there's a microchip issue there too. Certain food items, because they simply couldn't get there. We had the ability to go out and do all those things that we couldn't do while we, as you so eloquently said, we're stuck at home with masks hanging off of our faces. And we've started to see those savings rates come down because we now have the ability to spend money. Revenge travel it was a great thing, still is a great thing.
Yep. So the savings rate here is affected by a lot of different things, such as the travel, as Alicia was just talking about, and people doing things. It's also the cost of living. If my food costs are higher, we're going to get into some different costs higher. But a great question came in from Brian. I really appreciate this question, Brian. We have a big shift happening. Part of, I don't know, make sure everyone understands, is part of the decision to allow the government to borrow more money after they already decided they were going to spend it, and the debt ceiling bill. It stopped the extension of the student loan for lack of payment, meaning they just didn't have to make payments. So we believe the way that it's going to work out in timing is going to be September 1st, student loan payments will be back full speed. The average student loan payment's about $450, and it's about $5 billion a month in student loan payments. And so we're actually going to see, as that happens, it should be slowing the economy. The savings rate will go down, and discretionary spending will have to go down. Also, there is a fight in the Supreme Court. There was the Biden administration put together a bill to forgive $20,000 of student debt, and we believe it's probably going to be found to be illegal because the executive branch doesn't have the capacity to spend money. They need the legislative. So we'll see what happens here, but it's definitely an interesting time, and I do expect that to be a pretty substantial issue to everyone on the call here, because people borrowing money will have less dollars, and people saving money will have less dollars to save.
Yep.
Okay. So speaking of components of inflation, we should add student loans here, but we have gas prices. Gas prices, while they were up quite a bit with supply chain issues and war in Russia kickoff and lots of things, they're still at elevated levels, around $3.75 a gallon on average for unleaded gas. Not the best spot, but not a terrible spot today.
No, and if you look back over time, we have that spike up there when gas was incredibly expensive during COVID. But if you look back over the last, what is this graph, roughly 20 plus years, 2010 through 2000, almost 16, we're slightly lower than we were then. So we feel that gas is cheap, and yes, it's definitely up, but it's at a reasonable cost compared to where we have seen it in the past.
Yeah, I'd love to see it get down below 3. That would become in line with more of the average. A lot of that is a political situation. If we go back, a lot of the politics that were in place here were do not build any pipelines and stop every pipeline. And when you get a political environment against drilling for oil and natural gas, it causes prices to go up. Hopefully, we work on a slower process of entering, and you'll hear some comments of me about energy and energy policy. I think we have a terrible energy policy in our country, and hopefully we can improve that. But we're also seeing oil prices, which is really, it goes down to diesel, and that's what we look at this primarily for, but it does affect gasoline also. We're down from the highs that we hit with supply and demand problems. We're also down from the COVID, or up from the COVID negative numbers when people couldn't give away oil.
It was just sitting in barrels.
Yeah, but it's still definitely higher than where we'd want it. As it comes down, if we do see oil come down, that is a leading indicator of a slowing economy, meaning there's less demand for oil.
Absolutely.
So this next graph's my favorite because it's a neat little squiggly line, and that squiggly line there, besides looking like a bunch of cursive R's, comes down to summer and winter. And the reason why we have summer and winter here is we're looking at electricity prices per kilowatt hour, the average U.S. city. It's been consistently on the rise since the 80s. We're doing pretty good, and then we saw this crazy stuff happen here, and then the recent crazy activities. Definitely not a good number. A lot of this here is based off of policy. We're attempting to move to green energy too fast, in my humble opinion. We should be growing nuclear capacity. We should be trying to be as clean as possible. But solar and windmills are not as efficient and don't make energy as cheap. So this is something I'd love to see us get back closer to a 12 to 14 average cost per kilowatt hour. It would be really nice to get this drop back down. I don't think we're going to see that given the current administration, but that's something I think that would be very helpful to everyone in the country.
Most definitely, especially given coming up on the summer season.
Yep, the air conditioning season here in Michigan. Also, that's called the construction season, and then the next season is the heater season. But we talked a bit about eggs. What do you see with this graph, Alicia?
I see a significant amount of ups and downs. One of the things we've talked here in the office, we can see, looking at the right-hand side of the graph, we all know the cost of food went up during COVID, mostly due to supply and demand. Couldn't get the food from the farms or the manufacturing facilities onto store shelves, or even out of the manufacturing facility because they didn't have the items. One of the big debates here in the office has been, are we seeing technical deflation on food, or are we seeing it return to a quote unquote normalized price? I know there's several things that I buy as a mom for my family that went up significantly during COVID and have now returned to their pre-COVID price. That increase in price wasn't necessarily it in part came from the manufacturer, but it wasn't a permanent increase. It was a supply and demand increase. So the prices went up because they couldn't get enough of it in. Obviously, there's demand issues because I'm specifically speaking of Annie's mac and cheese. For those of you who have kids, it's a household staple. It's now come back down to the same price. It's $1.25 a box versus $1.75 a box. But is that deflation, or is that simply a return to normalcy?
Yeah, I love it because the answer is yes, of course, which is the easiest one.
Absolutely.
It is deflation if you go from the top point, but it is also a return, and it's also a potential supply and demand issue. And so a lot of great points here. We're talking about eggs and the avian flu and the killing of birds and lack of supply. But it is also important to note when you get into a recession, the dark lines here are recessions. You'll see that each of those, into a recession, what ends up happening is the price of food goes down. And a lot of that is because consumers shift their buying habits from more expensive things to less expensive things.
Yep.
And we see that the inflation goes away as companies try to get people to buy things. So we are coming down from this high point. So we are having some deflation, some returning to normal, whatever we want to call it there, because the outcome is the same. But it
Right.
still is more expensive today. And the reason being to remember here, even though this number is coming down to 5%, we'll call it, from 14%, we're still up 14, then plus the 5 of this year. So that
Right.
means food prices up are 19, 20%. And so it compounds on each of these until you get a negative time, such as these two instances back in the recent history.
Yep.
Well, what's making the Fed's job very difficult today goes back to Alicia's comment on the dual mandate. Price stability and full employment are the two mandates the Fed has to go with, and it's hard to do both because to not have inflation, you want to have not a good economy, but to have full employment, you want a good economy.
Yep.
And so that's one of the dichotomies the Fed has to deal with. And if we look at the situation here, this is a really neat graph, actually. It's one of my favorite graphs. It tells a lot of stories when looking at the labor force participation rate, going back to the 70s, 60s here, and all the way to today. I think it's fair to say we've recovered from COVID numbers here. Everyone's back to work. Is that fair?
Well, is everybody back to work? How many open jobs are available per person right now?
Yeah, there are a lot of open jobs right now.
A lot of open jobs right now. The unemployment number, which I know is on another graph, it shows that we're back to pre-COVID levels. We have a lower unemployment rate now than we did then, but the labor force participation rate, we're getting there
We're
slowly
close.
but
Look at that.
surely.
We're
Yeah.
really close. Interesting here, if we look back, we put this red line here to show that we haven't been at this level of utilization, labor force participation rate, since back in the early 80s, late 70s. And what was here? Well, that was again the 62, 63%. A lot of women were entering the workforce at this point. Eventually, we got a lot of kick up from the baby boomers.
Mhm.
Baby boomers all back from the war, getting to age to work. But we also have an aging population, which gives us for some of this happening here. But this has been a marked decline in participation in just a few short years. If you look at this, that's really going from 2010 to 2015. That's a big reduction of people in the workforce.
Huge. And then we have that spike there during COVID. A lot of baby boomers simply retired. They didn't want to have to deal with the health aspects of dealing with COVID in the workplace. If they were only a couple of years away from retirement, they kind of threw in the towel early and said, I'm done.
Yep. Sometimes you don't want to deal with the problem and move on to the next moment.
Yep.
Well, as you mentioned, unemployment rate has really come down since the COVID spike. Now, I made some snarky comments about our government and the helicopter money and giving everyone money. There was a part of that was good versus seeing massive bankruptcies of businesses and people having nothing to eat because they couldn't go to work. They couldn't do anything. So there is some positive to it. The unemployment rate did skyrocket up. Michigan went way up, more than national, but national did hit 15%. Michigan, we got up to 20% plus, so really big numbers. But in the end, it fixed it. So there's positive there. I can't just ignore that. But here we are with the national unemployment rate down to 3.7 and the Michigan unemployment rate down to 3.8. Since for Michigan, we'll quote that one today. But we are seeing a little bit of a tick up in the unemployment length right now to 21.2 weeks.
Yep.
So the Fed needs to raise unemployment to slow the economy, to slow inflation.
Correct.
And so that is one of the big reasons why they use the federal funds rate to make it more expensive to borrow money, more expensive to do things. And that's one of their main keys here. And so we'll talk about the Fed funds rate in a couple slides. But that's the main reason why they do that, is to then slow the unemployment rate, lower the unemployment rate, or increase the unemployment rate. So with that, one of the main things I know that's on everyone's mind today is what's going on with deposits and where are we going. So, Alicia, this is an interesting graph. We've got some bank data here today.
It is. Deposits here, the amount of deposits in FDIC insured institutions. You can see them rapidly rising over the last couple of years and now starting to slowly come back down. One of the things I'm hearing from my clients is that on the commercial side, deposits are mostly holding steady. We're not seeing any sort of massive outflow. However, on the consumer side, we are starting to see those deposits decrease. Whether it's a transfer from our non-maturity deposits into term deposits or a decrease, it speaks to the fact that consumers are in fact having to spend more money because inflation is up.
Yeah, it's people are spending money and they're spending it more, and they're spending on travel, but I also think general life is costs a little bit more right now.
Life is definitely a little more expensive. I mean, you hit on it with gas as well. The return to work, we're all putting more gas in our cars, and that does eat into consumers' bottom line.
Yeah, absolutely, absolutely. And student loans, that's going to be another thing that's going to make deposits very, very tough to keep around.
Absolutely.
I appreciate that comment about where you're seeing people and consumers spending a bit more, businesses saving a little bit more, or spending a little bit less, I should say, probably, versus saving a little bit more. A lot of competition out there today.
Just a little.
Yeah, and you got on your iPhone and put some money into the Apple savings account, right?
Absolutely. I was part of the group who moved $1 trillion in 4 days on the Apple money market account.
Absolutely amazing. Apple starts one with Goldman. It's not a bad margin when you're paying out 4.15 on $1 trillion, and you put it in Fed funds at probably 5.25. That's not a bad 100 basis points on $1 trillion.
To say that's not a bad arbitrage play.
No, I kind of would like $1 trillion to do that today. We are definitely seeing some competition out there. Goldman Sachs is a 450 money market account. American Express keeps sending me emails daily about their 470 money market accounts. A lot of competition out there today. One of the things that we talk quite a bit about in the office here today, and thinking about this, we don't see this competition for deposits going away anytime soon.
No.
And so really think it's a good day to really be proactive on raising your rates appropriately so you don't get into a problem with money running out the door.
No, there's, as I say, I don't know if I have any clients who have not run some sort of term deposit special. Just looking to hold on to those deposits before they leave the institution. As much as none of us want to have to pay more for those deposits, I'd rather we pay up for them and hold them than leave, because it's harder to raise new non-maturity deposits than it is to hold on to members and clients than we already have.
So one of the things we've been seeing people do is try to understand where the risk is. Where is money going to go out the door? And a lot of times it's looking at the large money market accounts. That's where the money is going away from. Now, is a large money market account for you 25,000, 50,000, 100,000, whatever the number is? Quantify what's a large money market account you think you may lose, and then cross-reference those accounts with people that have active utilization of online accounts, or even better, if you can cross-reference those people with people that have active smartphones utilization. Because with a smartphone, it's much easier for me to think about transferring money at 9 o'clock at night, sitting on the couch. And so I would look and see all of my customers or members that have large deposits and money market accounts that have smartphone access. I'd want to reach out to them proactively and potentially move them to a new higher yielding account, so I don't have to chase them or lose them and chase some new money in the door.
Absolutely. Most of the time, that's where it's going to happen. People don't typically walk into the branch and say, "Hey, I'm considering moving my money today. What will you do for me?"
It's, I moved it yesterday. Bye.
Yes, exactly.
Well, speaking of CD specials and rates, these rates that you were sharing with me yesterday when finalizing a few things here were, I think, shocking is the term I'm going to use for the CDs.
I was going to say eye-opening.
Yeah, that's a good
Even
term.
I was slightly surprised by them. I knew that we had been trending upwards, but it's quite the market out there. The liquidity crisis is real. A lot of 6-month and 1-year CDs at 545. There's a handful of them at that 5% level, or even slightly below. Once you get out to that 18 to 24 months, they're definitely below 5. But 6 years and 1 month, roughly 5.25 to 545. There was a lot of 545s out there, and even some 555s and 560s, which kind of blew me away.
Yeah, that's some big numbers. So whatever you can do proactively to not have to chase money at these rates would be really important. But we are seeing rates come up across the board, and it's important that we address it and then stay at the right spot at the right time and not come into a big liquidity problem.
Yep.
If though you are struggling to keep deposits around, which I know a number of people are, we're really seeing borrowings kick up quite a bit. The usual suspects. I love that. What a great movie too. Usual suspects, but the Federal Home Loan Bank, correspondents, OIAs, brokered CDs, the Bank Term Funding Program, the BTFP is really, really exciting because those rates are, that's what I find exciting, which is awesome. But it's really exciting because those rates are lower. We're in the mid 4s right now. And so it's actually mid 5s now. Thank you.
Mid 5s, yep.
Mid 5s. So it's actually not a bad spot to borrow, especially if you're looking at a 550 CD. So there's some decent, depends on the day, but it's based off the 1-year swap rates.
It
banks
depends on
and,
the, yes,
okay.
it depends on the day, but it's also, you don't have the haircut on it that you do on an FHLB borrowing. It is you're stuck with I don't say stuck. You can only go out to a 1-year term, but you don't have the haircut that you get on FHLB. So for institutions who already have that Fed line set up, it's fairly easy to take advantage of.
Yeah, that's a great point. Most when you're pledging a security, you're going to get about a 25% haircut from the market price, and where they're not doing any haircut from the book value, the par value. So
Par
really,
value,
really
correct.
exciting. Yeah, par value. So it's a great way to borrow. Some things though to make sure you avoid. When we see puttable advances where you lose the optionality and you give the other side the optionality, that's a bad spot. Negative convexity, one of my favorite words, is a tough thing today. And what we mean by that, negative convexity means as interest rates rise, my asset duration extends, and as interest rates fall, my asset duration declines. Such as if I write a mortgage today and interest rates go down, that mortgage is going to pay off very quickly. If you do puttable advances, it's the other way, where if rates go up, they get to refinance them on you, and rates go down, they stick around.
Yep.
And then the other thing is long term. Make sure you're using your asset duration, and if you're borrowing, that you're thinking carefully about how that duration may modify if interest rates go up or down. All right, moving off to one of your favorite topics, the housing market.
Love it.
Yeah, it's incredible. So
Is
what's going
it?
on in the housing market?
We've got some supply and demand issues. Given where housing costs or house costs themselves have moved over the last year or so, combined with the increase in mortgage rates, has given us a significant increase in housing costs altogether. So that supply and demand issue is causing an issue with people who have to move, because there aren't a lot of people who want to move, just given the increase in what housing costs are.
Yep. So it's really an interesting time right now. I always like to stir up emotions in conversations. It's always fun. But the talk is about the dual class system in the country. Those that have 30-year fixed rate mortgages at roughly 3%, and those that don't. If you have a house and you have a 2.75% 30-year mortgage, the likelihood of you actually moving is going to drop like a rock.
I was gonna
And
say
so,
slim to none, I
yep,
think would be the appropriate answer.
yep, one of the three Ds, death, disembark, and divorce. Those are the three reasons why people will probably move, and that's it. And that's why this blue line here, which is existing home sales, it's coming down with a little bump here with some spring selling, but we're going to expect to see that come down dramatically.
Yeah.
Um, New home sales are, fairly pathetic, and have been that way for about 10 years now. But one thing this graph doesn't show, if you go back pre-financial crisis, the average was closer to 1 million. And before the financial crisis, I should say, or the housing crisis, whatever you want to call it, we got up close to 2 million new units built a year. And so we're way, way low on the number of new homes being built, which then adds to that wonderful statement you made earlier, Alicia, is supply and demand.
Yep. Well, then if you look at that next graph that you have here, it looks at, our construction permits. Because the cost to build is so high right now, and the cost of materials is still elevated as well, just inflation, again, supply and demand, we have a decrease in our construction permits because everything is more expensive, whether we're looking at the lumber to build the house, the whole house itself by the time we're said and done, and the labor to build that house as well.
Yeah, definitely a difficult time to build right now. And but with the supply chain problems getting fixed, we'll probably see it get a little bit better as time goes by. One of the things I do think is just to visualize this headwind, we have here the Case-Shiller Home Price Index, National Home Price Index, and we saw the run up in prices, and then the topping, and the financial crisis, the housing crisis. We bottomed out around 12 and slowly started coming back up, and then the rocket ship lit up again. We had
Yes.
the Falcon 9 rocket shoot here, and what that really was is the turbo activity was the reduction that we saw in the 10-year Treasury, the mortgage rates, and the blue line is the 30-year mortgage rates. And so as mortgage rates hit all-time lows, people could afford a lot more house, and
Yeah. Go ahead.
that really shot values up.
Yeah, and it's one of the metrics we talk about all the time. Today, so I'll start a year back. A year ago, you could buy a $750,000 house at 3%. That same payment today gets you between $300,000 and $350,000. So the buying power is just significantly diminished.
And this is really interesting to me as we see this little blip here. We had home prices coming down. I think it's a little spring selling, a lot of pent up demand. The interesting issue here is demand going to be so strong that irrational pricing continues, or do we see pricing come down? And we are at an all-time low level of home affordability in the country.
Mhm.
So really, really amazing stuff. I'm going to go to one more slide, then I've got a question I want to address here.
Yeah.
But it's interesting when talking about home values, it always goes into real estate, and you can't watch CNBC without hearing about commercial real estate being a disaster every about 5 minutes. Um, just to go through this, be clear about it. There are different types of commercial real estate and different types of reality. Warehouses, for example, are doing amazingly well. As we've talked a lot about supply and demand problems, a lot of them have been fixed, but there's also a lot of warehousing that's happening much closer to the end consumer. So there's more demand for warehouses and holding of goods and services. Retail is doing okay. It depends on where you are, um,
Hmm.
and people are still going to Starbucks, right? And so we're
Yes.
seeing it happen. But the big issue is office, and it is not every city. We see that there's a lot of issues with some cities with safety and security problems. We hear a lot about San Francisco. We hear a lot about Chicago and people not feeling safe, and therefore the people not going back to the office. But as people hopefully return to the office a little bit, that'll help these numbers, right?
I think it will. I think there's definitely been some pushback in the return to work. We've heard a lot of the big companies requiring or mandating employees be in 2 to 3 days a week. I know speaking to a client last week, their return to work policy was 3 days in the office, 2 days at home. They tried it. It simply didn't work. So they opted for 3 days at home and 2 days in the office. So I think it's going to be a combination of not only what works for each company, but regionally, it's very different. I have friends in a couple of cities where they never really worked from home, period. Had nothing to do with the type of job that they had. It was kind of like an up north Michigan thing where COVID didn't exist, everything was still open. In their part of town, COVID didn't exist, nothing really ever shut down, so nobody ever really worked from home. So that office space is in part dependent regionally based on whether or not a return to work mandate is in place or people really didn't go back to home to work.
It is interesting to me when even the tech companies, Google is mandatory 3 days a week in the office, Amazon 3 days a week, and it is
Mhm.
changing. So we'll see how that'll happen, but it's definitely going to be a struggle as a lot of real estate, especially commercial offices with low vacancy, are coming up for
Yep.
renewal of their loans. Before we go to lending, Rick asked a great question. What do you think about callable advances where the financial institution has the option to put back the advance? And
I love this question.
then you get to take it.
I actually just talked about this with a client yesterday. We were walking through a various number of funding options, and we looked at what if we take the option to put it back to FHLB. I think it's a great option. The FHLB knows what the rest of the market knows, and it's 100 basis points more on average in order to take that callable option. So while it is a fantastic thing to be able to do, it's also going to cost you 100 basis points more than your standard borrowing. And that was for short term. I think a 1 year, I think we looked at a 1 year or no, a 5 year with a put, and I think it was close to 550 or 545. And the 5 year borrowing rate was a 4%.
Yeah, definitely it costs more. I do like them. I agree with you.
Yep.
Amortizing advances are another thing that if you are booking things you think may prepay, an amortizing advance may be a good thing to help offset that. So that might be another spot, Rick, that could be a little bit cheaper. But with that in lending, through a couple slides here quickly. Um, a lot of large banks have stopped lending, and that to me is a big mistake. They've stopped lending because of capital constraints, liquidity. We want you to keep lending. We want you to keep lending, and the reason being, you need to keep adding new, higher yielding assets. But the key is you have to lend at proper rates. So good lending and lending at proper rates are going to continue to help you improve your earnings, which is going to be able to get you going there. Really, really important. Now, one of the things talking about lending at correct yields. Alicia, as we were going through this slide here, I told you a number of accounting firms have stolen this slide. They put our logo on it and tell me they're doing it, so they're not really stealing it. I've had some people get mad at me saying I'm not being very nice, but I'm looking here as a buildup: 5.25 incremental borrowing costs, servicing costs, CECL, loan loss reserve. Got to have a 1% ROA. So I get a 7.5% neutral rate. but also a lot of people are not lending. So I get to put an additional spread in there, which gets me to 8.5. What are your thoughts on this?
I think the key is price your loans appropriately and don't compete with your competition. We as advisors hear a lot, well, I can't raise my loan rates because the institution down the street is at XYZ. Let the institution down the street be at XYZ. Because on the other hand, I have several clients who consistently raise loan rates and the loan volume isn't stopping. So even though they're pushing through 50, 75 basis point increases on loans, the volume isn't changing. You need to be able to price your loans appropriately so that you as an institution can survive at the end of the day. Because we have this significant increase in our cost of funds, we have to be able to continue to increase our loan rates so that we can hold on to those spread and margin numbers, because we're already starting to see them compress in the first quarter of this year.
Yeah, really important. Remember, you have a different customer base or membership than other people. And so if you compete with someone, you don't know their uniqueness, you don't know what they're doing, what their customer base may be. It's important, yes, you want to know where people are lending, but don't set your prices based off of other people. You need to set them off of your true costs and your incremental borrowing costs. Something really, really important today.
Yep.
We're going to continue to see yields high for a while, and as we get into investing here, there's still a lot of uncertainty. So I think it's a great thing to look at it.
Before you roll in there, we do have a
Yeah.
quick question on loans.
Yep.
How they want to know, in your example, how many months is that 850 tied to?
Yeah, so this was a generic buildup of a kind of a 5-year type loan.
Okay.
And because of the shape of the yield curve, you can pretty much use this for any loan out there today. When you get longer, you might want to shift to in commercial lending. I want to shift to the 5-year or 7-year Treasury or Federal Home Loan Bank borrowing yield curve versus go off something as simple as this. I mean, you could modify the incremental borrowing off of a term, but that's where I started here was kind of a 5-year, 4-year type borrowing structure.
Perfect. Thank you.
You're welcome. Great question. So I'm going to just flip through a couple things on investing here. The S&P 500 has done actually fairly well compared to where we were at COVID times. And you can see when before COVID, we were around 3,300 or so, and we almost got down to there, but we've come back up from our little dip here. One of the things that happens when we look at the stock market, the S&P 500 and the NASDAQ here, which NASDAQ really got hit, and it's been recovering actually very well this last 6 months or 3 months or so. One of the things that happens with the stock market valuation is stocks are valued off a discount of their future cash flows and growth, and we use the 10-year Treasury as the discount factor. The market uses the 10-year Treasury as a discount factor. So looking at the stock market and what's happening there, there's a lot of uncertainty, a lot of volatility right now. A lot of baby boomers getting close to retirement also. So we're definitely going to see some unique things happen here. But the rotation happened from people buying software to help them with productivity to already having bought it, and now that cycle of buying has been delayed. But with that, the bond market really is going to drive the stock market because the discount rate. As we talked about a lot of volatility in the stock market, Alicia, we definitely have a bit of volatility here in the 10-year Treasury.
We certainly do. I know one of the things I had mentioned to you today is normally, and normally may be the wrong word, long time ago, if the 10-year moved 1 or 2 basis points, you, myself, and Craig, we were all standing around the Bloomberg, oh my God, what happened today? What happened today? Trying to figure out why the 10-year moved. If the 10-year only moves 1 or 2 basis points in a day, we're not concerned because it's become so normal for it to bounce around so much. If we look over the last, I believe this is 20 plus years on here, we can see right around that 3% mark, it fell. We had the recession in there during 2020, very brief, and it's consistently come back upwards. But the amount of volatility just over this year alone has been significant. We normally don't see that much movement on the 10-year.
Yeah, we were talking even yesterday. There was a 5+ basis point swing of yield, and it's shocking. And so this is going to cause a lot of valuations in stocks to be very difficult with uncertainty. And then the option models do take in volatility as one of those components. So definitely a very important thing.
Yep.
Well, think of the bond rates. A lot of it is modified by this thing called the Fed funds and the Fed funds target rate.
I'm not sure if I'm familiar with that, Charlie. Can you give me a brief rundown of what the Fed funds rate is?
Yeah, it's this crazy rate where we can deposit money as a financial institution overnight, and then we set this thing called prime rate 3% over it. Although we have to do SOFR now, I guess I've got to change my terminology. I love the sarcasm because it has been incredible what's happened with Fed funds here. Just a skyrocket of rates up in a very short period of time. The first pause in 14 or so months, as Craig wrote in his economic update or his update yesterday. But big changes here.
Big changes, but when we compare these increases to the increases we saw in the 80s, these are very nominal compared to the volatility we saw back then. From a percentage standpoint increase, we doubled just like we did back then, but we're doubling on a smaller basis this time.
Yeah, but we definitely more than doubled, going from 25
Yes,
basis
going from
points
25 to 5. Yep.
It's a big number.
Still a
But
big number.
yeah, it's a big number. But I do think one of the things that has not set into a lot of the industry and into a lot of payments, um, a lot of these changes haven't flown through to loans yet
Mm-mm.
because of the speed of this activity. And that's one of the things I think that's really not well understood yet. And even though the Fed did say yesterday that they need to take a little bit of pause to watch the effect of the rest of these rate increases get into the system.
Yep.
And
They
so with
acknowledge the lag.
yeah, they acknowledge the lag, and it's really important. And so what does that mean? Well, lag wise, I first thought, man, did we do a mistake when we pulled this chart? And this is the Fed funds futures, which is the predictions based off the betting in the market. This isn't our recommendation, our expectation. This is the market. So the market is saying in July they're going to go up to 550, September unchanged at 550, November unchanged at 550, December 525, and January 525. Alicia, what are your feelings on this?
Highly unlikely. I don't think that we will see an increase in July and a decrease in December. Not to say that we won't see an increase in July or September, just based on Chairman Powell's language from yesterday. My expectation is that I hope they acknowledged the lag yesterday. Take a step backwards. Chairman Powell acknowledged the lag. He acknowledged that their movements take time to go through the market to be realized and affected and see what happens with them. So I hope that they pause, and I hope we don't see any future increases. If we continue to see the unemployment rate move upwards, which I know sounds somewhat backwards because we typically want to see it stay where it's at or move down. But if we can continue to see it move upwards the way it has the last couple of reads, and we continue to see inflationary readings come downwards, then hopefully this is the top of rates and we start to see the Fed funds rate move downwards.
Yeah. So the futures are never perfectly correct by any stretch, but
No.
usually the big picture activity, like they're flat or they're rising, they're falling, is correct. And so here it does go along with our predictions as of recent, and as we go forward here, we do expect the Fed to stay relatively flat at this point. They may go up 25 basis points, they may go up 50, but I don't think so. We think they're about done at this point, and they're going to wait for more information. We see what happens here going forward. But going back to our conversation earlier, the best way to understand what's going to happen here is watch the PCE, the Personal Consumption or Expenditure Index. If that comes down and continues to come down, less likely the Fed is going to do anything. Then the second thing would be the unemployment rate. The unemployment rate ticks up, the Fed will be less likely to do anything.
Yep. Agreed.
So we're going to hop into projections on our next slide here. Before we get into our projections, you do this for a living, so maybe you could talk a little bit about what this means in the shape of the yield curve, because I started to see a lot of similarities today. And I look back at the black line being the 10-year treasuries, kind of decoupled from Fed funds here, and the blue line's the two-year treasury, which has started to decouple from Fed funds, and the red line is federal funds rate. Is this graph telling me we're at a high point and that we need to change our investment strategies?
It sounds like you know how to do my job better than I do.
Yeah.
There is a lot of decoupling there. For those of you who I talk to often, you know this is one of my favorites. That blue line being the two-year treasury, the red line being the Fed funds rate. For the majority of the time on the graph here that we have, the blue line is above the Fed funds rate. When we start to see those lines become inverted, where the Fed funds rate is above the two-year treasury, typically means that we are at a high point in rates. So all that being said, I know not many of you have excess liquidity to put in your investment portfolio right now, but for those of you that do, making sure that we're staying on the same path. We don't necessarily need to change our path in order to accommodate the inverted yield curve. I know it's hard when you see short-term rates much higher than long-term rates, but we want to make sure that we're following the same duration that we have in the past, because in a year or two, those rates have the potential to be lower as that curve uninverts. Stay away from negatively convex bonds. So stay away from mortgages, stay away from callable things. Charlie mentioned negative convexity earlier in the call. As if we were to buy mortgages, if mortgage rates start to fall, those bonds come back to us quicker. We don't get to hold on to them for quite as long. And continuing to watch credit. Now is not the time to start adding a significant amount of credit to the portfolio. We still really like taxable municipal bonds. Issuances have been light as of late, and we've lightened up on some of our corporate purchases just from I wouldn't say a credit concern standpoint. There isn't a lot of value in the market. When we start to see things priced the way they have been, it makes us take a step back and take some pause. Just because yields seem exceptionally high doesn't mean that they're not exceptionally high for a reason.
Yeah. Well put and well said. And it's a difficult thing to go out a little bit longer to lower yield, but every time we go through the cycle, that is the correct thing to do.
It
And
is.
so something really hard, but to start thinking about today as we head there. Well, to wrap up our call, we have some projections for everyone today. And I think here, this is the 5% question, the Fed funds rate, right? Inflation.
Yep.
Is it here? Is it gone? And I think you did a great job, Alicia, pointing out supply and demand problems did cause a lot of things. We can argue if eggs have had deflation or not, but they're back to where we started. And so a lot of things are coming down. Not everything will, though. Once people have the capacity to charge more for things, they don't usually lower them. I don't
Correct.
see General Motors saying, "Gee, we're able to sell a truck for $50,000. Let's reduce it to 45." And people get used to prices. So
Correct.
hopefully we're not looking for deflation. I want to be clear, but we're looking for a lack of price increases on a go-forward basis.
Correct. It's a good way to say it. I like that. A lack of increases.
Yeah, that's and yeah. Hopefully we're stabilizing at zero. I like that. Unemployment. We've seen. I'll tell you, see a lot of layoff notices, a lot of battles out there in the job world of people cutting workforces. We tend to get a lot of warrant notices lately. Obviously, there's been a lot of pent-up demand still because we're not seeing unemployment numbers go up. But I do think we're probably going to see these coming up a little bit in the future. Do you agree with that?
I do. We've definitely started to see it come up. Our last read increased from 3.4 to 3.5 to 3.7. Continuing claims number today, again, was up above estimates. So I do expect to continue to see that number move upwards.
So housing, it's such a big thing, and I know this affects us from lending. It affects all of us from personal reasons, but all of our clients here in lending. It's hard to see that values could go up here. Do you agree with that?
I do. Yeah. I can't imagine them going up any higher than they already are right now.
Yeah, affordability is a big issue.
It's a huge
Supply and
issue.
demand is also a huge issue. Someone that's graduated from college and moved into an apartment and maybe starting a family, they want to get into a house, and it's very unattainable right now. So I do think a lot of technology will come out in housing and help reduce costs coming up here. But I do think that we're going to have to see a little bit of a price readjustment in housing. It may not happen because supply and demand. This is a very difficult one to predict right here. I think it's going to happen a little bit, but it's a tough one. Stock market, we think it's going to be challenging. Stock market, especially if the 10-year Treasury stays where it is, and we're going to talk about that on the next slide here. Definitely a lot of uncertainty out there and potential reduction of revenue as people spend less. And going back to the student loan question, as people spend more money on their student loans, we're probably going to see a little bit of an earnings reduction. With the bond market, Alicia, what do you see?
Yields up and or flat until we start to see that curve shift. And it's just asset class dependent. We talked a little bit about CDs. Those yields are up significantly. We haven't seen a lot of movement in other asset classes over the last couple of months. We've seen a few shifts in value here and there. It may only last a week or two before it shifts back, but yields up and flat until we are able to continue to bring inflation down.
Well, I think that's a great way to lead into the yield curve and then our projections, the next slide here.
Yep.
I do believe that we will get out of this inverted yield curve once the world believes that the Fed is reducing rates, and that's what we're wondering when that is, and that's a hard one to predict here. The Fed did say we start with Fed funds, which are currently 5.25, the high end of the range.
Yep.
They did see that they see their neutral rate at 5.60. Again, it's a bunch of betting on averages of all the Fed members. So it depends on how high someone went and how low someone went to really modify these numbers. We do think the Fed is done. That is our official stance here. Could they go up another 25 basis points? Absolutely. And I don't know if another 25 really matters more than mentally in a lot of ways. If they go up 1%, as one Fed governor said, that would definitely cause some strain in the financial system. But I think they're done and they're going to hold, especially because of deposit problems we're seeing. Slope of the yield curve, as you said earlier, we see that eventually flattening and going back to a positive slope, but it's not going to happen anytime soon.
No, it'll be a slow go. It doesn't happen overnight, unlike the increases in rates.
Yep. 2-year Treasuries of 4.65 today. We basically see that flat, then reducing a little bit about a year out.
Yep, roughly down to 4.30. And then I'll take the 10-year Treasury there at the bottom, 3.72 earlier today. And our anticipation is that it's flat around that level for the next year or so. So that would give way to the shorter end of the curve coming down and the longer end staying where it's at.
Yeah. So all that is very dependent. I appreciate that comment, Alicia. All this is very dependent on when the Fed signals that they're going to lower rates.
Mm-hmm.
And then the market starts to get ahead of them, and that's when we go out of this inverted yield curve. This may take a year. We may be in an inverted yield curve for another year, so we need to be prepared for that. But we need to watch these signals that we've talked about throughout the presentation.
Yep.
With that here, really, really important. We've been giving a lot of conversations and talks about ALCO and balance sheet management. Knowing your balance sheet and planning off of your balance sheet is extremely correct. And that's why Alicia spoke about how you don't want to price off of other people. You want to be aware of them, but you need to price off of your needs, which is going to be very different than other people's needs.
Yep. I'll take the next one there. We do think we are at the top in yields, looking at that 2-year and the Fed funds rate. Traditionally, when that Fed funds rate gets as high above the 2-year as it does, it means that we are at the top of yields, which then is the prediction for the next one there, potential recession.
Yeah, definitely potential recession. We are seeing some cracks in the economic activity. One is the office building, the pain that's happening there with vacancies. And we do think that also leads to a little bit of unemployment increasing, which isn't good because delinquency goes up, which means charge-offs go up, and they're coming up from record low levels, so it's not going to be fun.
Yep. I feel like we've beaten housing to death at this point.
Yep.
Still a supply and demand issue, definitely a cost issue in terms of affordability.
Yeah. And then in the end here, back in September, when we did end of September, early October 2022, we did our economic projection for 2023. I got a lot of hate mail from people out there on this call as I looked who was attending. I was told that when I predicted deposit growth of -5% for 2023, that's just a terrible thing to tell a board of directors. I do still think -5% deposit growth is going to be a good number for 2023. And as we look towards 2024, I think 0 deposit growth is going to be the spot to target. It is definitely a difficult market for deposit growth. We're not seeing the helicopter money come from the Fed anymore. There's going to be continued conversations that's going to happen with our government about fiscal responsibility because borrowing levels are getting so high right now. And the cost of debt has become so high. With that, I want to thank everyone for the questions along the way. And I want to thank Alicia for spending the time with me today. Thank you very much, Alicia.
You're welcome. Thank you for having me.
I really enjoyed the conversation. Hopefully you found it valuable. 2 last things here. Please call your advisor to get a copy of this or reach out go to our website or to our YouTube channel where you'll be able to get a copy of this later today. And then coming up next, we're really excited. We're going to take the summer off and not work is the whole plan. But no, our next webinar coming up will be in September, on September 13, ALM 301. This is a new one for us in our series of ALM. ALM 301 is really going to get into strategy and activity and utilizing our online ALM simulation application, running your own simulations. So really, really excited about that coming up. So with that, again, thank you, Alicia. Thank you, everyone, for attending, and have a wonderful day.